Welcome to Magnet Minutes. This is Jordan Kimmel with an update for January 11th, 2022. And today we have a special treat, an old friend and great colleague. It's Sam Stovall, Chief Investment Strategist for CFRA. And Sam, thanks so much for joining us.
Happy to be here, Jordan.
So Sam, you are one of the most sought out voices and minds on Wall Street. And I like to say nobody does it better. And we just have a couple of minutes right here to beginning of the year. It's a new year, a lot of new themes going on. And I want to introduce something to you, running against the wind. And what I mean by that in this case, I know you know where it's from. But what we expect this year, which is different than a lot of market participants, I should say new market participants, is interest rate increases this year coming. That we know for sure. We don't know the magnitude yet. And then secondly, we have some headwinds, I think, in terms of year-over-year earnings comparisons, coming from last year. So those are the headwinds I see. There's a lot of liquidity. And you are a champion of not only themes, but repeating themes. So let me just kind of jump it over to you, what you see, what you feel as this new year begins.
Okay, well, you're absolutely right. 2022 is the second year of a president's term in office, which is typically regarded as the sophomore slump. I say that because the average return at 4.9% for the S&P 500 since World War II is the weakest of all 4 years in the four-year presidential cycle. We also find that the second and third quarters are negative on average, the only negative quarters within the entire 16-quarter presidential cycle. And when you look at volatility, for the full year, it's traditionally 40% higher than the other 3 years. And those two quarters that I mentioned, second and third quarter, are 30% and 80% higher than the other 14 quarters of the presidential cycle. So basically, as Betty Davis once said, it's going to be a bumpy ride. Fasten your safety belts.
Right. And you know what? What's really important and what I really appreciate about you and myself, we're not dyed in the wool bulls or bears. It's a matter of reading tea leaves, reacting to things as they come. So, one of the themes that I talked about a lot and I want just kind of your reaction to it is, although the market, has this amazing run over the last couple of years, there's a overfocus, a well-documented concentration, if you will, on a handful of names, whether it's FANG, FANG-TANG, it's 20 or 30 names of overconcentration. And does that possess any extra risk to you, or is it something to get used to?
Well, it is something to get used to because the S&P 500 is a market cap weighted index. And you're indeed correct. The top 10 companies represent about 30% of the weighting of the S&P 500. So should something negative happen to those companies, well then, yes, it would have an adverse impact on the S&P 500 as a whole. One of the concerns that I do have is that a lot of these companies are concentrated in the growth side of the equation, whether they're from communication services, consumer discretionary, or technology. Also, historically, since 1953, whenever you have seen an increase in the 10-year yield, you've had a negative 0.5 correlation with PE ratios. So typically, in a rising interest rate environment, you do experience PE contraction, and usually that does not bode well for growth companies. So I think that that's what we're going through right now, is sort of a reset of valuation expectations for these growth stocks. mainly because we're going to be reporting Q4 results, and value is expected to post stronger returns on an earnings basis than growth. But as we head into 2022, Wall Street thinks growth earnings will rise by almost 11%, whereas value earnings will be up by less than 4%. So it's expected to be a reversal in 2022 as compared with 2021.
Right. And Sam, look, I think you're dead on there. And I also talk about there's a ratio between valuation and earnings. If too much is expected, even when those good earnings come in, if the valuation is excessive going in. And you know what I want to just bring out, because you talked about the 50s for just a minute. We know enough market history to know that the S&P will continue to evolve. And what I mean by that is we could remember when energy was a much larger segment of the S&P. We could remember when GE was once the largest company in the world. And the names change. The index has a way of kind of easing companies out and in. And I look back on the time when AOL was an unstoppable force before it lost 90%. And I just really urge investors not to get married to certain names and certain unstoppable forces, because after all, I don't think you and I used a Polaroid camera for some time right now.
No, but I do remember when the Swinger came out in the mid '60s. But absolutely, with the evolution of technology now, with the iPhone, you've got your camera, you've got your GPS, you've got everything in the palm of your hand.
Right, and by the way, as you know, I think what I'm hearing there is Apple, and I don't know anybody right now that doesn't love Apple. They also might not, though, have used a BlackBerry. They may have not used any digital equipment. So names do change, and it's kind of unusual how unstoppable names change. So let me bring something else out to you where I believe too many people have kind of dropped fundamentals and trade on algorithmic moving averages. And we see a lot of these trades taking place, and I think the market trades with huge energy right now in terms of the moves taking place faster with higher peaks and valleys. But I don't think these are individuals making a lot of decisions in a lot of cases. And algorithmic trading is relatively, it's only several years old. Does it pose extra risks?
Well, apparently it's been told to us that it's actually going to be reducing volatility because you have many of these algorithms that do take the opposite side of the equation. I think that we are always going to have fundamental investors, technical investors, and now algorithmic investors or quant investors, which is good if you have more people on different sides of the equation than it does in the long run tend to dampen volatility, but certainly increase liquidity. And so momentum investing, I still think will always be around. It just will go through its peaks and valleys. But I think the reason that people do look at technicals, they do look at algorithms, et cetera, is because the market tends to anticipate changes in fundamentals. I like to say that fundamentals tell you what, but technicals tell you when and how far. And so investors, I think, are no better than hyperactive first graders playing musical chairs, always trying to out anticipate the other as to when the music will stop.
Right. Well said again, Sam. And so you bring up fundamentals, and I want to bring up two specific things. So, and again, I know that you're very familiar with my magnet process, which marries fundamentals and technicals. Many years ago, when I would meet someone who wasn't looking for the growth strategy that I was using and was looking for more of a dividend strategy, learning directly from you, Sam, and you introduced me, frankly, to the dividend aristocrats. And the concept of increasing dividends put a floor under a company's valuation. Well, the other thing is that I really believe in is fundamental earnings quality. And so I use a variety of fundamentals, and I want to introduce now your ETF, the ETF that's sponsored by CFRA, which uses the Stovall mathematics behind it and trends. So please share a little bit on that.
Well, I wrote a book a few years back called The 7 Rules of Wall Street, and these are rules-based rotation strategies. So if you are an investor who unfortunately lets your emotions dictate your investment approach, well, if you're looking to extract your emotions from the equation, you want to embrace rules. One of those rules relates to the old sell in May and go away adage. But what I have found is that investors are better off rotating than they are retreating, meaning that the market tends to do very well November through April, but is a bit uncertain May through October, especially in midterm election years where we're coming up. I had just mentioned that second and third quarters tend to be negative. So what this strategy does is it embraces the more cyclical sectors, November through April, and the defensive sectors, May through October. There is an ETF. The ticker is SZNE. It's made available through Pacer ETFs. So if you go on to pacerfinancial.com, look up the ETF, you can see whether it's appropriate for you.
Right. And you know, terrific, Sam. And I have read that book. I also read one of your early books on sector rotation. And you were kind of early on that, and I've always admired it. And so two of the things, imitation's the best flattery. And so using the dividend aristocrats, I actually use a separately managed account that I manage here at Value Engine, which follows a lot of that and brings the magnet into it. And I think also the earnings quality that you've always talked about is part of what I introduced in my facts model as well. So I'd love to, you got to learn and earn from those that are the smartest in the field, Sam, and you're one of them. I want to ask you, you know, kind of a interesting point where we look at trends, we expect certain things to happen, and sometimes to deviate. And so what's really important is to be on your feet and to react. So what I'm just curious, is there anything going on in the market right now that surprises you or you think is acting different than we would expect?
Well, yes, what I'm finding is that but a couple of the old rules of thumb are just not working right now. I guess you could say because of COVID, from a seasonal perspective, the market has become a bit bizarro, meaning that defensives have done well November through April, and the cyclicals have done well May through October. Since this ETF has been out, it still has outperformed the market, but only by a small margin, mainly because things have been topsy-turvy. I do think that once the COVID situation has run its course, we will likely see seasonality get back to normal. But I think what investors have to realize is that rules of thumb, old strategies do tend to work, but they just don't work all the time. And so remember that Murphy's Law will step in, meaning that the year you give up on a time-tested strategy is the year in which it'll start working all over again.
Right. And so it's so important. You brought up a couple themes here, is the discipline, the control your emotion side. And again, I have to point out, modest Sam, outperforming, you're saying your ETF is only outperforming the market by a slight bit. And we know that most models, most managers don't outperform the overall market. So to outperform by just a little bit is pretty decent on Wall Street. So
thank you.
It's good to be modest. So I just want to kind of wrap up here by just asking the only other question I always have on my mind is, I love using my models. I love the fundamentals. I do believe we are going into more of a value strategy where value growth and momentum come into play. The one thing I'm really poor at, Sam, is seeing around corners. My mirrors don't work in that direction. So if there's anything that you would see that would maybe, I know you'll always stick to your discipline and I know you won't get emotional, but is there anything that you would see that says we're kind of off track and maybe it's even more defensive time than usual?
Well, I think it's looking at inflation and interest rates. Interest rates, in my opinion, are the primary driver for stock valuations because that's what can fluctuate in intrinsic value models to decide whether stocks are attractively valued or not. So I think that if we end up seeing inflation replicate the 1970s, well, remember that in that entire decade, the compound annual growth rate was only 1.6% because we started the year at about a 5.5% year-on-year change in headline CPI and ended the decade at 12.4%. So if we're in a very upward trending inflationary environment, things are going to be very challenging. And so it's the inflation hedges like energy and materials that will do well, along with the defensive utilities and consumer staples, whereas the underperformers are likely to be tech and consumer discretionary.
Right. No, I think that's really great analysis. And the one thing I'll just toss in there is what's actually missing in this environment is the competition from the bond market. And so if we do see rapid inflation or increasing inflation, probably there's more and more money still to come out of these 60-40 models where people are stuck in the bond market with low yields and then even eroding principal. So I think that's some of the support that I see coming in. I think that the sector analysis you have is dead on, Sam. I want to thank you for joining us on Magnet Minutes. It's a great way to start the year. It's Sam Stovall, Chief Investment Strategist, CFRA, one of really the most sought after minds and voices on Wall Street. So I appreciate you taking the time to join us.
Always a pleasure to chat with you, Jordan. Thanks.
All right. And no doubt we'll see you again, Sam. And great rest of the year and enjoy the rest of the season.
Will do. Thanks. You too.
All righty.